Have you ever heard of a hedge fund so powerful, so brilliant, that its failure could have brought down the entire global financial system? This isn't a movie plot. This is the story of long-term capital management, a firm run by literal geniuses who thought they had solved finance. In finance, nothing sells quite like genius. When the hedge fund Long-Term Capital Management, or LTCM, launched in 1994, it wasn't just another investment vehicle. It was a declaration of intellectual superiority. Its founding partners included two men who would soon win the Nobel Prize in economics, Moran Scholes and Robert Merton. They were the architects of the famous Black-Scholes model, the very equation that priced almost every option trade on Earth. Imagine having the guys who wrote the rules of the game running your hedge fund. That's the level of brainpower we're talking about. LTCM was built on a core belief, almost a religious conviction, that financial markets were rational. They believed that any weird price differences or anomalies were temporary glitches, and that their mathematical models could predict and profit from every single one of them. They called their system a black box, a secret, proprietary machine designed to suck risk-free profits out of the most complex corners of the bond, swap, and options markets. Their confidence was absolute. They famously boasted that their strategies were so complex and so well protected by Nobel-winning math that they were simply impervious to failure. They truly believed they had created a perpetual money machine. And for a while, they were right. The money flooded in immediately. Top global banks, massive pension funds, and the wealthiest individuals on the planet raced to invest with these financial superheroes. Who wouldn't want to invest with a team that had seemingly cracked the code to wealth? By 1997, after returning astonishing profits over 40% annually, year after year, LTCM was managing an insane amount of money. Their capital under management was equivalent to the entire GDP of many small nations. The fund wasn't just managing money, it was effectively functioning as a shadow central bank, engaging in transactions so large and so interwoven that no single regulatory body could fully grasp what they were doing. They had created a financial entity that was both too smart to fail and, as the world would soon discover, far too massive to be allowed to fail. So, how did they do it? LTCM's strategy relied almost entirely on something called convergence trading. The concept is actually pretty simple on the surface. Imagine you have two financially similar assets, let's say a US Treasury bond and an Italian government bond. Logically, their prices should move together and converge to a similar price over time, because their underlying economic fundamentals are related. LTCM would identify tiny, almost microscopic, differences in the prices of these assets and bet that they would eventually converge. But because the price difference was so minuscule, they had to employ colossal amounts of borrowed money, or leverage, to make the strategy profitable. It was like picking up pennies, but they were picking up trillions of them at a time. Leverage is the engine of high finance, and LTCM was driving a rocket ship. They initially leveraged their trades 25 to 1, which is already aggressive. This means for every $1 of their own capital, they were borrowing and trading with $25. But as their confidence grew, their models convinced them that the risk was practically zero, so they pushed the pedal to the metal. By 1998, their leverage ratio had exploded to over 100 to 1. Think about that. With just under $5 billion in equity, they controlled nearly $1.3 trillion in total assets and contracts, a staggering sum that was hidden away in complex derivatives and swap markets, off the balance sheets and out of the sight of regulators. They were making bets that dwarfed entire economies. But their models, as brilliant as they were, ignored one critical, human factor: black swan events. These are rare, unpredictable events that go far beyond what normal models expect. Scholes and Merton's mathematics relied on historical data and the assumption of mean reversion, the idea that no matter what happens, things eventually return to normal. Their equations could not compute global panic, war, or sudden political instability. LTCM's genius led them to believe their models were stronger than reality itself. They assumed that everyone they traded with, their counterparties, would remain calm and rational, even in a crisis. This over-reliance on historical probability in rational markets became the fatal flaw in the black box, turning it from a perpetual money machine into what would become the most dangerous financial bomb in modern history. The countdown had begun. The first crack in the armor appeared in the summer of 1997. The Asian financial crisis began to ripple across the globe. Currencies in Thailand, Indonesia, and South Korea collapsed. Markets that were supposed to be stable suddenly became wildly unpredictable. For LTCM, this was just another anomaly their models were designed to exploit. They saw it as a massive opportunity. As Asian markets went haywire, they doubled down on their convergence trades, betting that sanity would soon return. They were essentially betting against the panic, confident their math would win out. But the panic didn't subside. It spread. Then came the real bombshell. On August 17, 1998, Russia defaulted on its domestic debt and devalued its currency, the ruble. This was the black swan event nobody saw coming. For the markets, it was a complete shock. For LTCM, it was a catastrophe. One of their biggest and supposedly safest trades was betting on the convergence between Russian government bonds and other international bonds. When Russia defaulted, that spread didn't just widen, it blew up completely. The convergence they bet on turned into a massive divergence. Panic selling swept through global markets. Investors everywhere fled from anything perceived as risky and rushed into the safest assets available, like U.S. Treasury bonds. This flight to safety was the exact opposite of what LTCM's models predicted. All their carefully balanced trades, which were designed to offset each other, started losing money at the same time. The correlations that had held true for decades suddenly broke down. It was a perfect storm. The Italian bond spreads they bet on didn't converge, they diverged. The mortgage-backed securities they owned plummeted in value. Every single one of their core strategies failed simultaneously. The geniuses had bet that lightning wouldn't strike, and now it was striking everywhere at once. The losses were biblical. In a single day in August, LTCM lost over $500 million. By the end of the month, they had lost nearly $2 billion, vaporizing almost half of their capital. The problem was their massive leverage. With a 100-to-1 leverage ratio, even a tiny 1% loss in their asset values would wipe out their entire capital base. And their losses were far greater than 1%. Panic set in within the firm. The partners, who once believed they were masters of the universe, were now facing ruin. Their black box was bleeding, and they couldn't stop it. The real danger wasn't just for LTCM, it was for everyone. Because of their massive size and interconnectedness, LTCM's failure threatened to trigger a domino effect. They had borrowed billions from every major Wall Street bank. If LTCM defaulted, those banks would suffer catastrophic losses, which could cause them to fail, which would then ripple through the entire financial system. It was a scenario of complete financial meltdown. The Federal Reserve, led by Alan Greenspan, realized that LTCM was too big to fail. It was too interconnected to fail. In late September 1998, the New York Fed took an unprecedented step. It organized a private sector bailout. They gathered the heads of all the major Wall Street banks, the very same banks that had lent LTCM the money, into a single room. The atmosphere was tense. These were fierce competitors, but they all understood that if one went down, they all might go down. After hours of tense negotiations, they agreed to inject $3.6 billion of new capital into the fund to prevent its immediate collapse and allow for an orderly unwinding of its massive positions. It was a bailout not by the government but by Wall Street itself, orchestrated by the Fed to save its own skin. The story of LTCM serves as a timeless warning about the dangers of hubris, over-leveraging, and the illusion of risk-free profits. It showed that no matter how brilliant the minds or how sophisticated the models, markets can be driven by fear and panic in ways that no equation can predict. It taught us that relying solely on the past to predict the future is a recipe for disaster. The Nobel Prize-winning geniuses learned a very painful lesson. In the real world, reality is always more powerful than the model. The collapse of LTCM was a dress rehearsal for the even bigger financial crisis that would strike a decade later, reminding us that the line between genius and catastrophe can be terrifyingly thin. Have you ever heard of the hedge fund that almost broke the world? A firm run by literal geniuses, Nobel Prize winners, and the sharpest minds on Wall Street. A firm so confident in its mathematical models that it believed it had eliminated risk. This is the story of long-term capital management, or LTCM, and how its spectacular collapse in 1998 gave the world a terrifying preview of the 2008 financial crisis. This isn't just a story about money. It's a cautionary tale about hubris, the limits of genius, and a concept that now haunts our financial system, too big to fail. To understand how it all went so wrong, we have to go back to the mid-90s. LTCM wasn't just another hedge fund. It was an intellectual powerhouse. Founded in 1994 by John Meriwether, the legendary bond trader from Salomon Brothers, the firm's board read like a who's who of finance and economics. It included Myron Scholes and Robert Merton, who would win the Nobel Prize in economics in 1997 for their work on options pricing. These weren't just smart guys. They were the guys who wrote the textbooks. They believed they had created a black box, a set of complex mathematical models that could identify and exploit tiny, temporary pricing mistakes in global bond markets. Their core strategy was called convergence trading. The idea was simple, at least in theory. They would find two similar assets. Let's say a newly issued U.S. Treasury bond and an older one. The older, less liquid bond would trade at a slight discount. LTCM's models predicted that, over time, this price gap would narrow, or converge. They would buy the cheap one, short the expensive one, and pocket the difference when the prices met. For a few years, it worked like magic. The returns were astronomical, often over 40% a year. Wall Street's biggest banks, from Goldman Sachs to Merrill Lynch, lined up not only to invest in the fund, but also to lend them staggering amounts of money. This is where the real danger began. Because the price differences LTCM exploited were so tiny, the only way to make huge profits was to use massive leverage. For every dollar of its own capital, LTCM borrowed over $25. By early 1998, the fund managed about $4.7 billion in capital, but controlled over $1.25 trillion in positions. That's trillion with a T. Their balance sheet was larger than that of many developed countries. The geniuses at LTCM were so sure of their models that they told investors their strategy was as safe as earning interest on a bank deposit, just with much higher returns. They believed that a catastrophic loss was statistically impossible, an event that would only happen once in the lifetime of the universe. They were about to find out how wrong they were. The first signs of trouble appeared far from Wall Street, in a place their models had overlooked. In 1997, the Asian financial crisis swept through countries like Thailand and South Korea. Markets became volatile, and investors started getting nervous. But LTCM's models viewed this as just another temporary blip, a market irrationality that would soon correct itself. The fund actually doubled down on its trades, believing the eventual convergence would be even more profitable. They held their ground, confident that logic and mathematics would prevail. But then, the unthinkable happened. In August 1998, thousands of miles away, Russia, reeling from a complete economic collapse, defaulted on its domestic government debt and devalued its currency, the ruble. For any financial model based on historical data, a major country defaulting on its own debt was a black swan event, a complete statistical anomaly. It was the one thing LTCM's models insisted could never happen, and its effect was instantaneous and brutal. Instead of markets calming down and prices converging as LTCM predicted, the exact opposite occurred. A massive global flight to quality began. They wanted safety. They dumped everything that seemed even remotely risky, including the very bonds and assets LTCM was holding and frantically bought the safest asset on the planet, U.S. Treasury bonds. This created a catastrophic divergence. The price gaps that LTCM had bet billions would shrink suddenly exploded outward. The risky assets they owned plunged in value, while the safe assets they had soared. It was a perfect storm, hitting every single one of their massive positions at the same time. The losses were biblical. The fund's sophisticated risk models had predicted a maximum daily loss of around $45 million. On one day alone, Friday, August 21, 1998, LTCM lost $553 million. In just 4 weeks, from mid-August to early September, the fund hemorrhaged $4.6 billion, wiping out nearly all of its capital. The black box was broken. The Nobel Laureates and their army of PhDs were forced to confront a terrifying reality that their equations could unsolve. When fear takes over, markets don't follow logic. With its capital gone, LTCM was bombarded with margin calls from its creditors. And who were these creditors? They were the very same Wall Street banks that had invested in the fund. This created a terrifying feedback loop. The banks demanded more collateral for the loans they had given LTCM, but LTCM had no cash. Their only option was to sell assets. But as they tried to unwind their massive $1.3 trillion positions, they flooded the market, causing prices to fall even further, which in turn triggered even bigger losses and more margin calls. The geniuses were trapped in a death spiral of their own making. By mid-September 1998, this was no longer about one failed hedge fund. It had become a full-blown systemic crisis. The real danger wasn't just LTCM's own losses. It was the web of connections it had woven throughout the global financial system. The fund was a counterparty to virtually every major investment bank on the planet. If LTCM officially defaulted, its $1.3 trillion in derivatives and trades would become worthless overnight. This would trigger a chain reaction, a cascade of losses that would hit all of its banking partners simultaneously. The regulators at the Federal Reserve realized with horror that if LTCM went down, it could take the entire global financial system with it. Banks would have no idea who was exposed to what. Fearing that their own counterparties could be insolvent, they would immediately stop lending to each other. The credit markets that act as the plumbing of the world economy would freeze solid. The result would be an instantaneous global financial paralysis, a scenario potentially far worse than the 1987 stock market crash. The world was staring into the abyss. With the global financial system hanging by a thread, the U.S. Federal Reserve had to act. On the evening of September 23, 1998, the chairman of the Fed, Alan Greenspan, orchestrated an unprecedented emergency meeting at the New York Federal Reserve Building. The CEOs and top executives of 14 of the world's most powerful banks were summoned to a closed-door summit. The mood was grim. The message from the Fed was blunt. This was not a taxpayer bailout. The government was not going to write a check. However, the Fed was there to encourage a private sector solution. In reality, the banks were stomped. They were presented with a stark choice: either band together and rescue the fund yourselves, or face the catastrophic consequences of its collapse, which would likely bankrupt some of your own firms anyway. After hours of tense negotiations, the banks reluctantly agreed. They collectively injected $3.6 billion of new capital into LTCM. This wasn't an act of charity. It was an act of self-preservation. The money wasn't to save the fund's founders, who were wiped out, but to stabilize its positions long enough for an orderly unwinding, preventing a fire sale that would crash the markets. This private bailout effectively contained the crisis. But in doing so, it established a powerful and dangerous precedent. The rescue of LTCM was the ultimate confirmation of a new concept in finance: too big to fail. It sent a clear message to Wall Street: if you become large enough and interconnected enough, your failure becomes a threat to the entire system, and the authorities will not allow you to collapse. This idea would fuel even greater risk-taking over the next decade, culminating in the much larger crisis of 2008, where the phrase "too big to fail" would move from the boardrooms of Wall Street to the living rooms of Main Street. The story of LTCM is a stark reminder that no matter how brilliant the minds or how sophisticated the models, finance is ultimately a human endeavor, driven by the unpredictable emotions of greed and fear. The LTCM crisis was swiftly resolved, avoiding an immediate global catastrophe. But the most dangerous part of this rescue wasn't what it fixed, but the lesson Wall Street completely failed to learn. This crisis was the ultimate proof that even the most sophisticated financial models, run by literal Nobel laureates, can create systemic risk that puts the entire world on the brink. It was a giant, flashing red light showing that excessive leverage and complex, opaque derivatives are a recipe for disaster. So what happened next? Did the regulators step in and fix the system? Not really. The regulation that followed was minimal, almost laughably so. Instead, the Federal Reserve's intervention sent a very different message, one that only encouraged even more risk-taking in the future. Wall Street banks looked at the LTCM bailout and didn't see a warning sign. They saw a blueprint. They learned that the government would always step in to save the day. They realized that the more complex and interconnected they became, the bigger their implicit government guarantee. The lesson wasn't be more cautious, it was go bigger, because you're too big to fail. Fast forward less than a decade. The exact same playbook and same leverage. Complex mathematical models everyone believed were infallible, and massive interconnectedness was now fueling a $700 billion subprime mortgage market. And in 2008, it detonated. The specific financial instruments had changed. Sure, we went from bond arbitrage to mortgage-backed securities, but the core behavior, that reckless use of leverage, and that arrogant belief in mathematical certainty, was identical. The 1998 crisis was the perfect dress rehearsal for 2008. The lack of any real structural reform after LTCM wasn't just a missed opportunity, it was a profound regulatory failure. Think about it. The rescue of long-term capital management saved the system in 1998, but the complete absence of true accountability made the far greater crisis of 2008 practically inevitable. The final price for this betrayal by the so-called geniuses was unpaid by the Nobel laureates or the hedge fund managers. It was paid by the entire global economy 10 years later, by ordinary people who lost their homes, their jobs, and their savings. The most dangerous moments in finance aren't the crashes you see coming. They're the moments when everyone thinks things are stable and safe. My parents always taught me that understanding the truth about risk is the best foundation for building real wealth. If you want to understand how the system is often rigged to fail the individual investor and how to protect yourself, hit that like button and subscribe for more. Thanks for watching.